The investor's chief problem, and even his worst enemy, is likely to be himself. That's a quote from Ben Graham, considered to be the founder of what today we call value investing and a mentor of the legendary Warren Buffett himself. It's pretty interesting that it doesn't mention anything about the global economy, interest rates, conflicts, or even inflation. These things all matter, of course, and have an effect on the stock market. But what he's saying here and what's behind this quote is pretty interesting. You see, here's what I find really fascinating and I can totally relate to throughout my own investment journey. It's easier to buy a stock or to get started investing, especially now in the 21st century. We've got all the apps and tools we have at our disposal. We've got all the data at our fingertips. We can watch the news 24/7 for hot stock pick ideas. Or if we're feeling really adventurous, we can even look here on YouTube.
So if you want to speculate on a Chinese IPO, you've got my blessing to bet on DD. I would try to get as many shares as you can. DI.
There's so much coming at us now, and we've got to try and filter out the noise whilst trying to work out what's relevant and what's just hype. And this is where the issues come in. With all of this data and all this information coming at us from all angles, it's really easy to get distracted, wandering between one thing and the next, like some kind of goldfish. What ends up happening is, as investors, we commit one of the cardinal sins, which I can totally relate to in my past, and that is trading too much. You see, ever since the dawn of electronic-based trading and the ability to make stock trades without the slow process of calling up a broker, getting a price quote, and then paying through the nose to buy a few shares, the retail side of buying shares has seen a huge revolution. The problem is, though, this revolution has come at a cost. Not the initial cost of buying shares or the price to manage your account. Those have actually been falling over time and are constantly being squeezed. New platforms that have taken the world by storm, like Robinhood in the US, and other platforms over here like Free Trade and Trading 212 have done just that. The real cost to investors has been in their returns. Now, this isn't just my opinion on the topic. Let me show you the data and studies that have been done showing you this to be the case. I'll run through all of their findings, and then at the end, I'll give you some of my thoughts about how all of us might be able to avoid this trap so we can make more money during our investing careers, which is especially important in a market like this one. Some of the heavyweights in this arena are Barber and Odean. Now look out for their names if you're interested in some bedtime reading on the topic. One of their key works is a piece of research which they name "Trading is Hazardous to Your Wealth," something that should appear probably on some popular YouTube channels, but we'll leave that topic for another day. In this study, the academics looked at investor behaviour of over 60,000 households between 1991 and 1996. Without boring you too much in this video with the calculations and all that sort of stuff, here's what they found. Generally speaking, there was not much difference in the gross returns, as you can see here by this white bar on this chart, meaning that more or less how often you traded had no effect. However, when you look closer, it's the black line which shows the real returns of investors. Once you factor in the cost of their investing, commission and trading fees, including the cost of the spread, as you can see, it's at this point when the frequent traders really get punished for their net returns and they suffer. Now, just quickly compare that to these charts on the right, showing an average trader and an S&P 500 index fund. You'll see that the main differences between these are the impact that commissions and fees has on the returns you get back from your investment. Clearly, winning out would have been a simple index funds for these households because their returns would have just matched the market minus a very small amount of fees. Instead, they got stung by fees without even realizing it and ended up very much worse off. Oh, and one more point from this study too that was really interesting and might be worth considering is that of all of the stocks that these investors were buying, they were more favourable towards smaller sized companies. Now this does show a riskier approach, as smaller companies typically are more volatile, and although they have historically delivered better returns too when compared on average to much larger companies and did pretty well during that period, they can be the ones with a lot greater risk of falling quickly and going bust. Just worth keeping that in mind if you're seeing the same behaviours around you too. Open and shut case then? Trade less and make more money? Well, not so fast. The eagle-eyed among you will be thinking, hang on, I don't pay anywhere near that much to trade. All these newer platforms like Robinhood, Free Trade and Trading 212 don't charge anything and their spreads are pretty tight as well. And yes, you would be right. Buying and selling shares in the 2020s is a lot cheaper than it ever was, ever since the advent of the smartphone trading apps. So is there more to this story than just fees and commissions killing our profits? Let's look at some more data. Just before we do, if you are finding the video useful, it would mean the world to me if you could hit the like button and comment too. For small channels like mine, it has a huge impact and you'll get better stock market returns. Okay, that last bit may be false, but anyway, now back to the data. From the same academics alongside Huang and Schwartz, Barber and Odean did a more recent study looking at the effect that Robinhood had on investors' behaviour. The study doesn't have a name quite as catchy, it's Attention-Induced Trading and Returns, evidence from Robinhood users. This one was interesting because of a couple of their findings. In short, they looked at a lot of newer investors using this platform who tended to be younger and less experienced. Remember how everyone went crazy in the meme stock phase at the start of last year? Well, the results don't look pretty from those people who took part.
It is true that my investment in that company multiplied in value many times.
Here's what they argued. Apps like Robinhood in the US and many more that have popped up along the way here in the UK and across Europe have no doubt allowed more people to enter the stock market. However, the way the app is structured drives impulse buying and also concentrates the mind on a handful of companies that feature on the app. For example, the way the app shows the user the top traded stocks that day then causes more people to get involved in those stocks, driving the price higher and higher and so on. They call this behavior buy-side herding. As more and more people join in, things get a lot worse. Now, it's very funny to watch on the sidelines, especially if a short squeezes are going to happen, but for the average retail investor, they don't get much out of it. The study found that the top 0.5% of stocks that were bought each day then face negative returns over the next month. And in more extreme circumstances, those negative returns went almost 20% into the red. And unfortunately, because of the nature of newer people trading, many people were not able to hold on through the dip and they'd sell out at the wrong time instead.
Oh my God! Okay, it's happening. Everybody stay calm.
What's the procedure, everyone? What's the procedure?
Stay calm!
Now, it's not all gloomy. I know by now you're probably thinking I should just sell all my stock, stop trading and keep everything in an index fund and do nothing. And while that might be a great approach and I'm jealous that you have the ability to do that, there are some winners in this case. I did manage to scour some research from the Colombian stock market which showed that although they found similar results for frequent traders on the whole, that these also underperformed the market even on a gross return basis. So even without taking fees into account, there are some people who exhibit frequent trading behavior for a long time who do actually beat the market. So it is possible. However, we've got no idea if they managed to stay in the market because of skill or luck alone. What we're seeing here is survivorship bias where, given enough people in the market, some people will always come out on top, but it might not be something we can replicate. So what does that leave us poor retail investors left to do then? After looking at all of this research and data on frequent traders, I think there's a couple of takeaway points, but there's definitely a positive spin. Firstly, we're very fortunate to be alive during a time when it's very easy to invest in the stock market, with low fees and plenty of options when it comes to what we can choose to invest in. Every possible asset class is open to us, and we can pretty much invest all over the world, including just investing in the world itself through a mutual fund or an ETF. However, just because we can invest and trade stocks doesn't mean we should be doing it, especially frequently and often. As we know, in the short term, the price of a stock can do all kinds of things, and the reasons a stock price might move one day or another could be for any reason at all. It's only in the long term that ultimately the price of a stock reflects the underlying fundamentals of the business. But at what point that happens is completely up to debate. Trying to time the market in the short term across days and weeks is a zero-sum game. And in fact, even worse than that, as brokers take their commissions either upfront or via market makers. Remember that when you want to buy or sell a stock, there has to be someone on the other side of the trade. When you buy, someone else is selling, so presumably your bullish bet is another person's time to get out. I've made plenty of bad calls over the years, and almost every time I've made a mistake, it was because I sold early based on short-term fears and worries. So now I know how to spot and recognize those feelings for myself. I'm better able to control them. But I'm still not immune. It's never nice seeing red on the markets or fear from every media source you can imagine. To find a balance, I'm a big believer in using index funds that are low cost and track the stock market. And whether that's the S&P 500, which I like a lot, or something wider tracking the whole global market. I keep these funds as the core of my investing approach. And then you can actually watch all of my portfolio updates if you want. Just go ahead and check on my channel. Everything from Vanguard to Hargreaves Lansdown. I'll make sure I pop those links below in the description. Alongside that though, I do have my own stock picks, but I don't assume in any way that I'm some kind of guru or can beat the stock market. I'll certainly give it a go, but in the long run, if I am able to squeeze a couple of extra points, I'll be very happy indeed. I do this so I allow myself to look into the stock market and keep myself interested. Otherwise, I think if I just had index funds, as sensible as that is, for me, it would not be exciting enough. But that's the price I'm willing to pay. Also, anytime I feel urges to sell or make any big changes, I remind myself in an interesting article from Fidelity, which showed that between 2003 and 2013, across a decade, their best performing customer accounts were either dead or inactive. Literally, the best performing accounts did nothing. Not that they had much choice, but you get the point. Don't trade too much, it's dangerous for your financial health. If you've enjoyed the video, you might also like this one up next. It's all of my biggest losing positions so far this year. Some have got worse, some have got better. I'm in this one with you. Anyway, don't laugh too much. Until the next one, happy investing.